Live from Dubai, this is Bloomberg Daybreak Europe. I'm Abir Abahmad with your top stories. Chip stocks lead a global tech rally as Micron's sales forecast crushes estimates, boosting confidence in the AI trade. Brent crude erases all of its wartime gains as flows through the Strait of Hormuz ramp up. Plus, NATO Secretary General Mark Rutte says President Trump is completely committed to the alliance despite tensions with some European leaders. We'll bring you our exclusive interview next. Now, before we start with the show, a quick look at where markets are trading this morning. Asian equities tilting higher by the second, 1.7% higher, led by the Kospi in South Korea that is edging higher as well, 5% or so after a tech sell-off that we've been seeing throughout the week. Micron's results yesterday came in and really solidified the need for AI infrastructure. We're also seeing Euro Stoxx 50 futures edging to the green this morning, 0.1% higher, and then Nasdaq 100 futures a whopping 1.8% higher. It was dropping throughout the week, but then again, the tech picture that was driven to more positive territory by Micron yesterday has driven these equity indices higher. And then if we take a look at where oil prices are this morning, Brent prices are at $72.6 a barrel. New York crude was below $70 a barrel earlier in the session. And this happens as we continue to monitor the movement of ships through the Strait of Hormuz. Our energy teams point out that some pockets of the market have actually become oversupplied. So some good news to energy markets this morning. And the Bloomberg US dollar spot index is dropping ever so slightly this morning, 0.1% lower. It is at a several-month high still, and we keep an eye on this Fed hawkish tilt and how it has an impact on assets across the board, but also on the 10-year yields in the United States that are edging higher this morning, 2 basis points higher. We await key economic data out of the United States, PCE, and personal spending set to come out later today in U.S. opening hours. Our Bloomberg intelligence teams point out that personal spending and core PCE data are expected to affirm the U.S. Fed hawkish tilt. And then finally, for some of the risk events that we're taking a look at this morning at 7 a.m. UK time, German GfK consumer confidence numbers set to be out. 7 a.m. UK time as well, H&M results, we're set to see those come out. And at 1:30 p.m. UK time, US PCE, as I mentioned, the inflation numbers there are going to come out. This is what we have for you today. Now let's set you up for the day. Asia stocks are climbing after Micron's blowout earnings and outlook. Let's go to Bloomberg's Winnie Su in Hong Kong for more details on what's happening in Asian markets. Winnie?
Good morning, Abir. A pretty positive day in Asia today, supported by the lower oil prices and also, as you just mentioned, these upbeat results from Micron. Yes, you had that revenue forecast beating estimate, but more importantly, long-term contracts with the customers really helping investors to gain further confidence that the level of earnings that we're looking at right now is likely going to be sustainable and that the solid demand of memory likely going to continue. That's supporting the MSCI Asia here up almost 2% after 2 days of losses. We are seeing gains being led by tech-heavy gauges in South Korea and Japan, while we are still seeing the downside in the Hong Kong stocks. Hang Seng Index here down more than 1%, and we are just about 3% away from entering the bear territory. Remember, we already had MSCI China and HSCI entering that bear market earlier this week due to the lack of AI exposure. So we will likely going to see how this underperformance continue further. Now, flip the board, we take a closer look at the chip stocks because overall, yes, supported by these Micron earnings, but also specifically, we are looking at SK Hynix here, up almost 10%, the biggest gainer here in Asia today, with that news of the company seeking $29 billion of U.S. listing on the NASDAQ. We are expecting trading to start July the 10th, and that analysts right now are saying that this is likely going to help narrow its valuation gap with its global peers like Micron. And interestingly, similarly, we are hearing Kioxia here up about 11%, also saying that they are considering an ADR listing in the spring next year. Back to you, Abir.
All right, Winnie Su in Hong Kong with those market details as always. Now on Micron, let's get more details about it soaring in late trading after smashing expectations. Bloomberg market strategist Rahul Amin joins us now with more. Rahul, good to have you on. This was seen as yet another pivotal moment in the AI trade. Just how surprising were those numbers for you?
Hello, good morning. Yeah, so it was a great quarter for Micron. They obviously beat on the top and the bottom line. That wasn't a surprise because historically they've always beaten. And, we know that memory supply and demand has been very, very tight given the AI boom. But what's been more interesting is the guidance that they gave and the qualitative comments that they made around supply remaining tighter for longer. And that has enormous implications for the stock in terms of the way it's valued.
And Rahul, we've also heard about SK Hynix. It's back in the headlines. Is it fair to say that memory chips are the runway star of the AI trade at the moment?
Very much so. So that's been the narrative that's formed over the past 12 months or so. Obviously, memory is a huge component in terms of the AI infrastructure boom, and there are only a handful of suppliers globally that can provide this, SK Hynix and Micron being two of them. So as demand ramps up, given the AI infrastructure boom, supply has been very, very tight, and that has great implications for pricing and obviously profit margins as well. The big debate, of course, is this just another kind of cyclical story, or has demand become more structural? And that's what the market's trying to work out. Micron, of course, gross margins above 80%, which is pretty incredible. And because they said pricing and supply is going to be tighter for longer, profitability is going to be in focus very much. So yeah, implications for SK Hynix as well, and of course Micron.
All right, Bloomberg market strategist Rahul Amin with those details for us. Now, sticking with Micron, the results are set to boost stocks in the United States session, with NASDAQ futures pointing to gains. Let's bring in Mark Cranfield, Bloomberg MLive strategist, to discuss more. Good to have you on. How important is the chip sector story to markets overall, Mark?
Well, if you look at some of the things that have been going on the past couple of weeks, you might say it's the only thing that matters to global markets at the moment. It's one of those rare situations where something that appears to be relatively isolated to equity markets has become a macro theme. And our colleague in New York, Cameron Christ, has been doing studies of how significant certain companies can be for the broader markets. And he rates three of them in particular, Micron, Alphabet, and Nvidia. They're so big and important. When their earnings come around, they can shift the dynamics across asset classes. So that's why people were looking so seriously at what Micron had to say, as much as the numbers themselves. And you've seen the reaction, as your previous guests have been saying, that the reaction is huge in Asia today. It's boosted stocks across Asia, and it's also lifted the NASDAQ futures quite significantly, as you were saying as well. So you can tell that people are having to look at this from various angles here, what it means for the fixed income market, what it means for currencies, and also what it means for the equity space as well. So much money is pouring in to a limited number of companies here. It's sucking funds away from other places as well. And we're seeing that play out, particularly when you think about the Treasury curve. That's certainly the other side of the coin in terms of the money going into the equity space.
And Mark, we're also getting PCE data later today. How could those figures change the outlook of the market?
It's a huge number because it's the one that the Fed thinks about the most. They look at it very carefully in terms of their projections of where they see inflation going, how they help to set interest rates. For the time being, the market is still thinking that the Federal Reserve will raise interest rates at some time in the second half of this year. But what the PCE probably won't reflect is the fact that oil prices have come down significantly in the past couple of weeks. And that is changing the dynamics in terms of the outlook for where inflation is going. So if we see a PCE number which is in line or maybe a little bit softer, you could see a big drop in yields across the Treasury curve. If we get a high number, that's probably to be expected, and it will very much depend on what Fed Governor Warsh has to say in terms of where he thinks that's leading the inflation picture for the near future. But we're at this kind of inflection point where the drop in the oil prices has become very important. It's not fully priced into the market, and we're waiting to hear what Federal Reserve people have to say in terms of how they read that for the path going ahead, and whether they really need to raise interest rates or whether they can dial it back because they're more comfortable now that the war is past and inflation will start to ease as petrol prices and other oil-related factors come down in the United States.
All right, Bloomberg MLive strategist Mark Cranfield, thank you. Now, still ahead, the biggest U.S. banks pass the Fed's stress tests and ramp up payouts for investors. We'll bring you the details on that. But first, oil falls back to pre-Iran war levels as the increased flow of shipping in the Strait of Hormuz drives supply. That is coming up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Brent crude has erased all of its wartime gains as the flow of shipping through the Strait of Hormuz ramps up following progress on the U.S.-Iran peace deal. Let's bring in Bloomberg oil and shipping reporter Wei-Loon Soon to discuss what is happening in the Strait of Hormuz. Wei-Loon, good to have you on. Look, as shipping returns to Hormuz, could we see a drop in oil even further?
So we have shipping gradually return through the Strait of Hormuz as of now, and we do see certain ships going in and out. But beyond the 60-day peace deal between the U.S. and Iran, the status of Strait of Hormuz remains to be determined, right? As is the case of tolls that Iran pledges to take. But in the meantime, oil markets have found workarounds, and as we have seen during the war, prices have stayed have not shot up as much as we expected. And on the other hand, we have like demand destruction happening across different economies, especially in China, where we see a big shift away from fossil fuels into cleaner fuels. So overall, we do expect oil prices to trend lower, but how the supply production will ramp up to meet demand that has been affected by the war so far still remains to be seen.
And Wei-Loon, when it comes to the tolls across the Strait of Hormuz, if that were to happen, what consequences would that have?
We are still trying to find out what Iran is planning to do with that. But if any form of financial payments were to be made to Iran, that would construe a certain kind of sanctions risk that would have serious implications for shipping as a whole, because there are many actors that are involved in ensuring the safe transit and delivery of a cargo from point A to point B. Any form of financial payments to sanctioned entities would expose them to U.S. penalties. For now, the U.S. has waived some form of sanctions for Iranian oil and the delivery of it, but that's only within a very small window, which is until end of August. And at any point in time, the U.S. is able to rescind that sanctions waiver for now.
All right, Wei-Loon Soon with those shipping details that we've been keeping an eye on. Thank you. Now, NATO Secretary General Mark Rutte used a visit to the White House to try and ease tensions with the United States after President Trump lambasted nations in the military alliance for a lack of support in the campaign against Iran. Rutte displayed posters that featured gold lettering and bright red bar charts labeled, quote, the Trump trillion, to highlight the increase in NATO spending since Trump first took office. The Secretary General spoke exclusively to Bloomberg shortly after the meeting.
What I believe is to be fair when leadership is successful. His leadership is successful, and what I wanted to show today is that it's successful in three ways. One, on Iran, degrading nuclear capability. Two, on NATO, not only getting the allies to deliver, to commit to 5% defense spending, but also to deliver on the spending, and that's clearly what is happening at the moment. And third, by taking that coat, that mantle of being the leader of the free world. And when he meets in Ankara, he will meet with all the allies, but also 10 countries there as guests from the Middle East, from the Indo-Pacific. A total combined GDP of $70 trillion, 2.5 the size of the United States. Absolutely there to hear his views, to get his thoughts on the next steps we collectively have to take.
Well, of course, the financial aspect of this and the investments into the defense industrial base are one part of it, Mr. Secretary General, but there's also the consideration of actual human capital and U.S. military forces that are currently stationed all around Europe. Obviously, we've now seen withdrawals and considerations this administration is making about moving troops around further. How do you avoid anything being chaotic in nature as that plays out? And how does Europe make sure that it's able to adequately defend itself in a surprise scenario? What are those preparations like?
I think the United States is doing that. So let's first agree that the United States has to take care of multiple theaters, not only Europe, also, for example, the Indo-Pacific. And if a situation would occur where they have to defend both sides of the equation, both the Indo-Pacific and Europe, they have to avoid a situation in which they have spread their resources too thinly. This is why Europeans have to step up. This is NATO 3.0, a stronger Europe and a stronger NATO. That means that the US will stay involved when it comes to the nuclear umbrella, but also when it comes to the conventional. But over time, what you now will see, and this is a structured process, is that the Europeans are taking over more and more of that leadership role. For example, when it comes to the three combatant commands, they will over the next 18 to 24 months move from American generals and admirals to European generals and admirals. So that's also an example of Europeans stepping up. But also when it comes to Ukraine, the fact that the US is still providing all the support, but paid for by Europeans and Canada, which is only fair. So Europe stepping up, the US staying heavily involved when it comes to the conventional nuclear deterrence in Europe.
That was NATO Secretary General Mark Rutte speaking to Bloomberg shortly after his White House meeting with the president. And coming up, we'll look ahead to results from H&M as the retailer looks to turn its fortunes around. More on what to expect next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Clothing retailer H&M reports second quarter earnings this morning. The stock is down some 12% year to date amid concerns over weak consumer sentiment and poor spring weather across northern Europe. Let's get more details with Bloomberg's Rafaela Lindeberg in Stockholm. Rafaela, good to have you on. What are we expecting out of these H&M results due in about an hour or so?
Right, flat sales, I would say. If you look at Bloomberg consensus estimates, analysts are becoming increasingly concerned about H&M's inability to generate more top-line growth despite all its efforts. And sales are expected to have remained roughly flat in the second quarter. We'll also be looking out for comments on how the turnaround plan is progressing in terms of costs, especially how the Middle East conflict might be affecting input costs and the supply chain heading into the second half of the year.
And so how would you say H&M would be comparing to competition around Europe?
Yes, competition in fast fashion is pretty brutal, as we all know, and H&M's feeling the pressure from the industry leader Zara on one side and the ultra-low-cost rivals like Shein on the other side. But if you look back a decade, H&M and Inditex had pretty similar sales and were more or less seen as peers. Today, Zara is much larger and much more profitable, and they've been much quicker to adapt to consumer trends and changes in shopping habits, and they have a supply chain that allows them to react much faster. And much of what H&M is doing right now is trying to narrow that gap.
And speaking about the CEO, Daniel Erver, he took over in 2024. Do investors still have faith in the strategy that he's following?
Well, the CEO has done a pretty good job of making the company more efficient, lowering inventories and improving profitability, but the share price is still down. I think it's about 9% this year. Investors want to see more evidence that he can restore sales growth, especially with a renewed focus on H&M's core women's wear business that he initiated when he took over 2 years ago.
Raphael, the Person family keeps buying shares. What is the market reading into that?
Well, the Persson family already controls more than 80% of the voting rights but they've been stepping up share purchases over the past few years, and that has of course triggered speculation and expectation that they might be looking to take the company private at some point in time. That is not something that has been confirmed or officially announced in any way, but it's a theme that comes up frequently in discussions around the company.
All right, Bloomberg's Raphael Lindenberg with the latest on what to expect from H&M results due later today. Now, on to some of the other stories that we're following today. Volkswagen has agreed to sell a majority stake in its heavy diesel engine unit to Bain Capital, ending one of Europe's most hotly contested private equity auctions. Volkswagen says the deal will generate proceeds of around 7.4 billion euros. The automaker says it plans to keep a 49% stake in the unit in the medium term. Now, Alibaba shares fell in Hong Kong after a Bloomberg scoop revealed that Anthropic is accusing Alibaba of using thousands of fake accounts to illicitly access its Claude AI model. The company said it was the biggest attempt so far by a Chinese company to piggyback on the work of a top U.S. labs. That's according to a letter that Anthropic sent to several U.S. senators and White House officials. Now, before we head into the break, a quick look at where markets are sitting this morning. It's green across the board. MSCI Asia Pacific about 2% higher, led by the AI bellwether in South Korea, the Kospi. We're seeing a rebound across the board after those Micron results really delivered yesterday. $50 billion in expected revenue for the fourth quarter. That compares with an analyst estimate of 43 or just over $43 billion for the fourth quarter. Euro Stoxx 50 futures is 0.3 higher this morning. We await the opening in about an hour or so, a couple of hours. Nasdaq 100 futures 2% higher. They've been ticking higher by the second. And again, those Micron results really solidifying the AI infrastructure game. Now we turn to see what Brent prices are doing. They are ticking lower for a fifth day because of the war in the Middle East and the impact of the receding war in the Middle East. The US dollar is flat and the yield on the 10-year Treasuries is ticking higher. Now coming up, we'll talk about Andy Burnham and the clear path for him to become the next Prime Minister. That is coming up next. Live from Dubai, this is Bloomberg Daybreak Europe. I'm Abir Abamar with your top stories. Chip stocks lead a global tech rally as Micron's sales forecast crushes estimates, boosting confidence in the AI trade. Brent crude erases all of its wartime gains as flows through the Strait of Hormuz ramp up. Plus, NATO Secretary General Mark Rutte says President Trump is completely committed to the alliance despite tensions with some European leaders. We've brought you the details on that exclusive interview. Now, a quick look at where markets are at half past. We're still looking at green across the screen when it comes to equities. MSCI Asia Pacific 1.8% higher. Euro Stocks 50 futures 0.3% higher. Nasdaq 100 futures really rebounding there, about 2% higher. We've seen drops across tech stocks in the United States all of the past 4 days or so. And then with Micron's results yesterday after market, not only did the stock surge about 16% in the after-hour trading, but it led this positive contagion across equities in Asia and in the U.S. futures picture this morning. Now, if we flip the board and take a look at where oil prices are sitting, Brent is trading very close to $70 a barrel. It is at 72.7, so actually ticking higher, still losing for the day. It has been losing over the past 3-4 sessions as tensions in the Middle East ease and these negotiations between Iran and the United States keep going. But also we're seeing swelling movement in the tanker and shipment movement in the Strait of Hormuz. And then the Bloomberg US dollar spot index is flat to the downside. It is at a 7-month high. It is creating some weakness in other currencies around the world, so something to keep an eye on. And then the yield on the 10-year notes in the United States is 2 basis points higher. We keep an eye out for economic data that is coming out later today. That's PCE and personal spending data, to see what ramifications that has on the Fed hawkish tilt and whether we're actually going to see the Fed raising rates by the end of this year, keeping the hold and see stance for the time being. Now, for some of the front page news that we're keeping an eye on, the Wall Street Journal leads with a story asking whether any productivity boost from AI will come soon enough to temper inflation caused by higher prices for memory chips driven by data center demand. The Financial Times says 2 of the UK's biggest trade unions are increasing pressure on Andy Burnham to not select Energy Secretary Ed Miliband as Chancellor, arguing his North Sea oil policy has damaged jobs in the sector. But the Times says Miliband is playing a key role in developing economic policies for Andy Burnham as part of his transition team, particularly those plans with fiscal implications. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayBGo. Now, influential figures within Andy Burnham's circle have urged the former major and likely the next UK Prime Minister to break up the Treasury to go and refocus the government's agenda on growth. According to long-time ally Richard Lees, Burnham will seek to pursue, quote, flexibility within government spending and borrowing rules. I'm now joined by Modupe Adegbembo, economist at Jefferies. Good to have you on. Thank you for joining us from London. The UK currently seems like it's between weak growth and above target inflation. How does a premiership of Andy Burnham change the outlook for, or the meeting in the middle between those two things?
Thank you for having me, Abir. I think it's interesting because, as you mentioned, the UK has faced a lot of challenges, weak growth, high inflation. And I do think that when we're looking to a change in the Prime Minister, one of the things that markets are really focused on is exactly what their economic policy will be. And that's why markets, I think, continue to be focused on exactly who the Chancellor will be. And the fact that we don't have a kind of clear indication at the moment, I think is sending some signals to markets. But I think ultimately we need to understand what potentially Andy Burnham's focus will be on growth, and what his focus will be on other sorts of policies. Because I do think that from a UK perspective, the political risk and the political uncertainty that we've seen manifest over the last few months has weighed on economic growth. It has meant that even at the margins, growth has been slightly weaker than we would have anticipated, and that's something that I think could persist if we don't see more certainty going forward.
So I mentioned in the intro that he's going to be likely seeking flexibility when it comes to those fiscal rules, kind of setting apart from the course that Rachel Reeves had taken. How realistic is that really?
Well, I think the challenge is that, of course, fiscal rules, they are kind of designed, they're made by construction, so they aren't necessarily something that has to be, they have to stay the same. Of course, they can change, but we have seen quite a few changes in the fiscal rules. Rachel Reeves herself, when she became Chancellor, shifted the fiscal rules, and actually markets took that change quite well. But I think the challenge is that if we continue to see changes in fiscal rules, it may be harder for markets to kind of understand the reason that the rules are changing, and they may just see it as a reason to increase borrowing. I do think that if we are seeing an increase in borrowing, for example, to increase investment into growth kind of heavy sectors, that is something that I think markets may be a bit more comfortable with, but there are still risks. The UK, of course, when you look at gilt yields, is paying quite a high kind of premium to borrow. So that's something that I think Andy Burnham and the team have to take in mind when they think about making these sorts of shifts.
And so shifting course a little bit about the BOE. First, what do you think it does next? And do you think that the BOE is more worried about inflation persisting rather than slowing growth?
I think it's interesting because, of course, as you mentioned, the kind of energy outlook has been extremely volatile. But it does look like we're starting to see some of the energy pressures start to come off. I think that's important because for the Bank of England, what we've heard so far is that they're looking and they're worried about second round effects, but they're also looking at the fact that the labour market in the UK has been weak and the fact that growth has been a bit more subdued than they would have anticipated. So I do think that the Bank of England isn't in a position where they want to hike imminently, and I think that the Bank of England are likely to remain on hold. And I actually do think that, you know, if some of the developments we've seen in energy prices kind of persist, we could be talking about the Bank of England delivering cuts quite soon.
Modupe, I'm in Dubai, so I feel like I need to ask you this question. If those energy-led concerns from the Strait of Hormuz do continue to alleviate, does that get the situation in the UK better when it comes to the growth outlook, or do the domestic challenges, will they prove to be more important?
So I think it's interesting, actually. I do think if we see a slight easing in some of the energy pressures, there will be a lot more kind of strength in the economy. Because actually, when you look at some of the indicators that we look at, so if you look at PMIs, in the UK, they have been weak, but actually they've broadly remained in expansion territory. So I think the underlying drivers of the UK economy actually remain very solid. I do think that energy has played a big role in slowing some of that activity, and the fact that energy prices as well in the UK are quite high has been important. But I think the other challenge I see is around the politics. So I do think that if we were to see a continued easing in the energy outlook, it would be really positive for UK growth. But I don't necessarily think it would mean that UK growth would be kind of significantly higher. But I do think it would be a real improvement, which is, I think, welcomed.
So do you think that investors are at all underestimating the risks that rates could stay higher for longer in the UK? Is that something that you think is being actively underestimated, or is that not something you're thinking about?
No, I would actually say it's probably the opposite, because if you look at pricing, market pricing of rate expectations, markets have been expecting the Bank of England to hike this year. I think now, given the easing in energy prices, it's close to one hike that markets are pricing, but we've seen it go up to around three. So I think markets think that the Bank of England will deliver hawkishly. I don't think that's the case. I actually think that the Bank of England will remain on hold, and I think that they are biased towards cutting. So I actually think that the monetary policy outlook is probably more benign than investors are expecting.
So for Andy Burnham and for the UK in general, over the next 6 months, what would you say is the most important economic indicator that we have to look at? Would it be inflation? Would it be the labor numbers? Would it be growth?
That's a really good question. I think for the next kind of few quarters, the most important thing that I would be looking at would be investment. Because I think investment is not only a vote of confidence in the economy, but it's something that will, in the future, help to produce more economic growth. It's something that we've seen some weakness in investment, especially when you look at the kind of levels compared to previous years. So I think investment is one of the key areas that I would be looking at. And I also think we've heard more and more Andy Burnham talk about investment, but also talk about investment being kind of spread across the country. So I think those sorts of things, if they start to improve, will be very positive for the UK outlook.
All right, Modupe, we're going to have to leave it there. Modupe Adegbembo, economist at Jefferies. Thank you for your time today. Now, coming up, the biggest banks in the U.S. pass the Fed's stress tests and ramp up investor payouts. We'll unpack the results of that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. The biggest U.S. banks have boosted their dividends after passing this year's Federal Reserve stress test. The Fed exam, developed as a result of the 2008 financial crisis, showed that all the banks tested would maintain enough capital to withstand a hypothetical economic downturn. Let's get more with Bloomberg Global Finance reporter Laura Noonan. Laura, good to have you on. Talk to us about the results that we saw this year.
Morning. So thank you for having me. So what this result showed in a nutshell was that the 32 biggest US banks have a ton of capital. Now, we already knew this. This kind of quantified that. So they showed that if there were a big economic crisis and these banks collectively lost $708 billion, they would still have more than enough capital to meet the thresholds which regulators have set as a safe level of capital. So this is really showed what the banks hoped it would show, which is that US banks are currently awash with capital. They have lots of it. Banks argue this means that the current regulations they have are too strict and that they should be allowed to return some of that capital to their shareholders, which, as you said, is what they have started to do.
And Laura, what does the test really tell us about the likes of JP Morgan, Morgan Stanley, the biggest banks in the United States?
So they all have a lot of capital, and what you're really seeing with this is a continuation of the deregulation story leading to massive payouts to investors. So we saw last night 3 of the big banks, so JP Morgan Chase, Goldman Sachs and Citi, all increased dividends by double-digit percentages, so big increases in dividends. We've seen this since the deregulation push started. While banks talked a lot about the need to loosen regulations so that they could lend more, what we've actually seen is record payouts last year, and this is a continuation very much of that story. This is also the first year where the stress test results did not bind banks' dividend or payout policies. And that is why we saw those 3 banks coming out so quickly, because normally they would wait a while they worked through everything. This time, the Fed has changed the architecture around the stress test so that it was more of an advisory stress test. I mean, there was a note from one analyst saying this was really a nothing stress test because it didn't actually restrict what they could and couldn't pay, unlike other years. And that is also part of this big effort in the US to reduce the burden of regulation, which we've seen under the Trump administration.
All right, there you have it, a nothing stress test. That was Bloomberg's Laura Noonan with the latest details. Now, moving on to weather stories, a heat wave gripping Western Europe has led to record temperatures this week. Climate change is increasing the frequency and intensity of heat waves on the world's fastest warming continent. The Network for Greening the Financial System, a global central bank group, has published a report warning that more frequent and severe climate shocks will make it harder for officials to look past their economic impact. To discuss further, I'm now joined by Edwin, Millar, Bank of England, and NGFS climate economist. Edwin, good to have you on. I don't know what it feels like to be in the UK right now, but I'm hearing from a lot of my friends that it's incredibly hot. You've just published a report about how to tackle climate change as policymakers. What are the key takeaways from that?
Thank you very much. Yeah, as you say, it's really hot in London, and that only emphasizes the point that we're making in this report. The report's targeted at central banks, and they holistically discuss the implications of climate change, both in terms of physical risks and the transition to net zero. It discusses implications for central banks, and in particular for monetary policy strategy, where, as you say, the impacts of climate change are increasing and becoming more severe, and that can present difficult trade-offs for monetary policy. So in particular, they can introduce shocks to the economy that present trade-offs between stabilizing inflation and output. And these are the types of shocks that can be particularly challenging for monetary policymakers to manage. In many ways, they're similar to the energy price shocks that we've seen in recent years. And the report aims to provide a holistic discussion, both for central banks and monetary policymakers as they increasingly grapple with these shocks, but also for anybody who's interested in the macroeconomics of climate change, how that might change in future. And we bring a wealth of academic studies, innovative modelling, and a theoretical discussion to try and unpack these issues for central banks.
So in the UK, Edwin, how speaking of these shocks, how would you say the UK, for example, compares with other countries, whether in Europe or around the world, to be equipped to deal with those climate-led shocks?
I think that's a great question, and the advantage of this report taking place in the Network for Greening the Financial System is that we can reflect not just a UK perspective, but a global perspective. So the NGFS represents around 150 central banks and supervisors from around the world. And something that we've worked really hard to do in this report is to reflect the perspective of emerging markets and developing economies. Because emerging markets tend to not only be more vulnerable to climate shocks, for example, because their economies could be quite focused on agriculture, but they also are generally less well equipped to deal with them, with less fiscal capacity to introduce spending in response to the shock. So something that we've tried really hard to do in this report is to unpack the implications not just for advanced economies, but for smaller emerging markets.
So do you think central banks are underestimating the inflationary impacts that could be brought about by climate change over the next decade or so?
I think one of the key factors for central banks to think about is the uncertainty around those inflationary impacts. It's very challenging to model over these long-term horizons, given both the uncertainty of climate change and the uncertainty of the economy. What we bring in this report is some new modeling to try and look at the implications of both physical risks and transition risks and help central banks understand them. But perhaps more importantly, we set out a framework for central banks that's very flexible and can be used both in response to different shocks in future, but also before the fact as central banks are beginning to think about these issues. And a key part of that, and something that we unpack in the reports, is around communications, where there's really an opportunity for central banks and monetary policymakers to be on the front foot communicating about how they might interpret these shocks, how they might respond when they happen, which will make their response easier to manage when shocks do occur.
And Edwin, something interesting that was brought in the notes is that droughts, you mentioned, are the most inflationary, while floods are the most deflationary. Why is that?
It's a great question. So droughts in particular often affect agriculture and have large-scale impacts across the economy, which can lead to broader-based inflationary pressures, whilst floods, on the other hand, can be more localized in their impact. And the impact of droughts in particular on food prices is one of the key ways that we see transmission of climate shocks, both to individual economies but also across borders. If we take the UK as an example, some of the exposure of the UK to climate change is through the fact that we import a significant portion of our food. So shocks that are happening in distant parts of the world, far away from the UK, can have spillover effects to UK inflation, and that's similar for many other countries.
All right, Edwin, we're going to have to leave it there. That's Edwin Millar, Bank of England and NGFS climate economist. Now, plenty more is coming up. Stay with us. This is Bloomberg.
Human intelligence is unbelievably efficient. You know, in terms of in many ways you can measure that. Energy efficient, obviously, but also data efficient. So there's some spectacular things that the brain is doing that we still don't have anywhere near those capabilities, I would say, in AI.
Demi Sabi is Google DeepMind CEO and co-founder, speaking to Bloomberg's Francine Lacroix about human and AI from the Cannes Lions in France. Now, before we head out to the end of our show, let's take a look at some of the charts that we're taking a look at today. One is about U.S. tech lagging behind some of its peers. This chart is plugging U.S. tech sector against MSCI Asia tech and EU tech. So quite surprising there. The talk has been about the U.S. tech over the past few days, but it's really lagging behind some of its peers in Asia, where the Kospi is, and it's the best performing equities gauge so far this year. Now, if we flip the board, we take a look at some AI infrastructure charts, and that is who gets paid after chips. We've got three companies, Quanta, Eaton, and Vertiv. The chip story has been all over the market this year. The memory chip story, Micron results yesterday solidifying that AI demand. And the AI rally is set to lift some European tech stocks at the open, including German semiconductor maker Infineon, which is gaining on TradeGate this morning. Shares finished lower yesterday on this week's tech sell-off, but are up more than 100% year to date. You can see it right here. Now, the opening trade is up next. Stay around with us for that. This is Bloomberg.